everyone.
Hello.
Welcome to, thank you for coming. Welcome to Websites for Anything, and welcome to Boss. If you haven't silenced your cell phones, now is a great time to do that. My name is Josh Walton, and I'm the president here at Websites for Anything. And our passion is helping micro businesses improve and grow, and we do that digitally through designing, building, hosting, and supporting your websites. We also do that through our speaker series, Boss. Business Owner Success Series was designed to help Fredericksburg area small business owners with practical, actionable advice. And so we bring in local experts to share guidelines and tips in their area of expertise and to answer our questions to help us all improve our businesses. I would also like to thank our sponsor, Minuteman Press in Fredericksburg. Minuteman shares our passion for helping small businesses make a great impression. And whereas we do that digitally, they do that physically through paper tools you need, like business cards, flyers, postcards, banners, and more. So today I'd like to introduce our speaker for 5 Bookkeeping Secrets, Shelley Kasten. Shelley is the owner and CEO of Not Just Numbers. And she is a full-time, has been in the accounting industry since 2005. She has been an enrolled agent with the IRS since 2016 and has been a QuickBooks Pro advisor since 2009. She loves it when her customers are able to take back to their own businesses everything they have learned from her and incorporate that information effectively. Her greatest joy, however, is her family and leaving them with a heritage that they can be proud of. Her hobbies include what her family has come to call the epic Kasten adventures and reading fiction books. But please join me in welcoming our expert for today, Shelley Kasten.
So I do have some handouts. You guys want to follow along with those? Oh, sure. That's awesome.
Thanks. Can you give me one for Bob too? Appreciate it.
Thank you. Okay, so I'm not the best public speaker in the world, but we'll get through it together. And since I do better with Q&A, we'll just kind of like breeze through some of this or what I have, and then we'll do questions and answers. So to begin with, if you aren't using an accounting software, you really should be. Spreadsheets are great, but yeah, your life would be a lot easier if you're using accounting software. And even though I'm a QuickBooks Pro advisor, I'm not here to sell that. If you're using Sage or Xero or Wave, something like that, I think it is, there's a bunch of free ones that are out there that are more than capable of handling your accounting needs. So before we get started into the screw-ups, to get started, if you don't know what cash and accrual basis is, we're going to kind of touch on that real quick. If you're doing your own finances and reporting, you'll really want to understand this. So basically what it is cash basis is the date that you're taxed on is the date that the income is received and the date the expenses are paid. Accrual is opposite. You're taxed on the date the income was earned and the date the expenses was incurred. So for an example, you have a client that you billed that day, and they came in and did your services or whatever, and it's today, but you gave them an invoice and it's not due till 15 days from now. Cash basis would be when you got paid in 15 days. That's when you're taxed. Where accrual would be you're taxed on today when you actually invoiced them. Okay, so that's kind of what the difference is. Most service-based businesses are cash, just because it is, you're really not doing a lot of accrued with accounting and things like that. And so most service-type businesses operate on a cash basis, which is definitely the easiest. And Basically, if you're less than 25 million in gross income, the IRS says you can definitely be cash basis. If you are doing a lot more than that in your business, then you basically would have to be an accrued. And if you have some type of inventory, you more than likely would have to be an accrued basis too. But definitely talk to your accounting professional, and they can kind of walk you through what the best option for you would be. So when you are giving financial reports to a bank, though, sometimes they want to see accrued basis reporting, even though you're a cash basis, because when you run cash basis reports, accounts payable and accounts receivable do not show up on the balance sheets. So even though you're a cash basis company and that's the way you're being taxed, sometimes you need to have the ability to hit the button in your software and run accrued basis reports so that the banks can kind of see the overall health of your company. Okay. All right, so let's go to the 5 most common bookkeeping errors. So the first one is the main one, and that's called transaction coding. I've listed 6 main categories you can kind of code to in your accounting software. Most accounting softwares will have these. The first one would be income, which is the funds that come in from the sales or services that you provide. The next one would be cost of goods sold, which are purchases made by the business for you in order to provide the service or the product that you're selling to your clients. Expenses are purchases made by the business for your operational purposes, things like rent, utilities. And then there's the other 3 that are not as common. These are your assets, which is cash. Most likely this would be your bank accounts, but if you are a retail type business, you might have petty cash, which also needs to be part of what you're doing and calculating in your accounting software. Then you'll have accounts receivable, fixed assets with some tangible assets and intangible assets. Liabilities are accounts payable with current and long-term liabilities. And then equity is anything to do with the owners, retained earnings, and net income. So most of the time you're going to post to what is income, cost of goods sold, or an expense account, okay? Those 3 are the main accounts that you'll use, and 95% of the time you'll actually post to those. It's the other 5% that you got to kind of be careful of. So in the income category, say you went to Staples and you bought office supplies and then you returned something and you got a refund. Well, when it's coming back in through the bank statement, you're looking at it, it's underneath the deposits, and you go, oh, this is income because it's underneath the deposits. It's really not, because you spent it on office supplies, so when the refund comes back in, it actually needs to code to an expense account, the office supplies expense account, even though it's coming through as a deposit, and would most likely, your natural reaction would be go income, 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 income. So you just want to be careful on those refunds that you're getting. In the assets and liabilities categories, the large purchases made with a loan would be considered a fixed asset and then post to an asset type of account. And then the loan portion would actually post to a liability account. If you purchased it with cash, this is pretty easy. If you purchased it with cash from the business accounts, it would just basically post directly to an asset type of an account. So in the equity category, there's several types of transactions to watch for in this category. These would be monies contributed from the owners. That would not be considered income. That would be considered a loan to the company or equity, like capital contributed. And then anything drawn from the business, like personal fund, anything drawn from the owners or the shareholders would also post to an equity account. And then if you are out and about, I know sometimes you don't always have your business account cards with you or whatever, so if you use your personal funds for something inside of the business, you'll need to make a journal entry in your accounting software to make sure that you take care of the fact that you contributed money personally to the business or that the company is going to reimburse you for that. So sometimes that little piece as owners gets lost, because you're just out and you're about, you're going, here, I gotta get office supplies, and, you have a bunch of other stuff at Staples, and some of it's for home, and some of it's for the business, and you just give them your personal debit card. So a portion of that for the business would actually need to be coded into your software as if, the company's either gonna reimburse you or, you contributed that money to your business. The other thing is if you're making estimated tax payments for your company, for you, it's really, especially with pass-through businesses, estimated tax payments are actually a personal expense, not a business expense. And so you don't want to code those tax payments under an expense account. You want to code it to equity, and then it will show as if, you took a draw, but and it will show as income to you. But it's really, especially with pass-through type businesses, those types of payments are for you personally, not for the business, unless you're a corporation. Okay, so all right, so the second part is, I'm sorry, go ahead.
I had a question.
Yeah.
Could you give me like an example in the assets? Could you give an example of like an intangible asset? I just saw that as one of the
Intangible assets would be like goodwill, or if you purchased a client list from somebody, something to that. It's not tangible. It's not a fixed asset. You can't see it, but you did purchase something from somebody else, and that becomes intangible. All right, so the second thing is bank, credit card, and loan reconciliations and downloaded transactions. So I'm going to touch real quick on downloaded transactions. Most accounting softwares will sell you or try to sell you the fact that you'll never have to enter any transactions in your accounting software ever again. That's not necessarily true. Don't listen to them. So a lot of times when the downloaded transactions come through, and I'm not hitting QuickBooks or Intuit, but a lot of times it'll try to help you. They'll create rules, and if they see this one particular vendor and you normally post to office supplies or rent or something like that, if they see that vendor come through, they'll try to help you and post it there again. But it doesn't necessarily mean that that's really what happened that day. So you really have to be careful when you kind of go through, not just to hit the add button or say that it's okay. Kind of make sure you're going through those transactions and realizing what happened that day and code it correctly to whatever account that might supposed to be. The other part is that you need to reconcile. So you can't just rely on the fact that your downloaded transactions from the bank are coming in. Yes, that's a good feature, but it's technology. It doesn't necessarily always mean that every single transaction came through. So your bank and credit card statements and your loan statements are proof. That is your Bible when it comes to reconciling, and you need to go wherever your feature is in your accounting software and reconcile every single month. You need to take your bank statement and you need to put in the ending balance, mark off all those transactions, and get a 0 on the difference. If you don't, and you've got years out there, months out there that you haven't reconciled, you may have missed a deduction that you might have been able to take on your tax return. So you want to make sure that you're doing those reconciliations. When it comes to loan accounts, a lot of people don't understand the fact that the loan itself is actually on the balance sheet. And when you're paying the principal to the balance sheet, because, all right, let's just say you bought a company car, all right, and you got a loan. So when you're entering the piece, the fact that you bought it, the car itself is a fixed asset that goes on the balance sheet. Then you got a loan, that's a liability, so that goes on the balance sheet. Your car gets depreciated, okay? That's how you get the expense, the depreciation expense. That's where you're able to take, whether you do it all at once, whether you do bonus depreciation, or whether you take it out over the course of 5 years. That's where the expense piece happens with your tax deduction. The loan piece, when you're making those loan payments, the principal of the loan is not deductible because you're taking it here as depreciation. But you are allowed to take the interest paid as an interest expense. So when you're coding the payments, you want to make sure that it's a split transaction in your software. You're going to code the principal part or the principal portion to the loan, and then the interest to the interest expense. So when you're doing your loan reconciliations, the only thing that you'll see is the principal paid and the ending balance on what the principal is when you're doing the loan reconciliations.
I just heard call Shelley. That's what I heard.
Yes, you could do that, yes. I can walk you through the first couple times. But that's basically what happens. The interest portion is on those payments is the only thing that's deductible and would be coded to an expense. The other portion is actually being depreciated already. Okay? All right, so the third thing would be entering payroll. So a lot of times when you're using those downloaded transactions, only the net amount is actually coming through on the payroll piece of that, not the gross amount. And you're actually allowed to take the gross amount of payroll that you paid plus the employer's portion of the taxes paid. So when you are processing payroll, sometimes a lot of people will process payroll outside of their, they'll have a different vendor. They feel like it could be cheaper. So if you're already processing payroll inside of your accounting software, through whoever that might be, it's probably being done correctly. So you don't need to worry about that. But if you're using like Paychex or ADP or something else like that, and then you're bringing those transactions into your software, then most likely you're not coding correctly. So I kind of put in your piece here inside of your handout what a journal entry might be. And of course, this is QuickBooks Online. This is what I had access to in my sample companies. So basically, the checking portion there, that's what's actually being debited from your account for the direct deposits for the net pay. But you actually get to take the gross amount paid, which would be the $5,000. And then you're going to want to post the payroll tax liabilities as what is being withheld from their payroll checks. So you may actually be able to put both of these in one journal entry, depending on whether or not you get one debit from your third-party provider, payroll provider, or two debits. It just depends, okay? But what you're going to do is you want to code what's being withheld from their payroll checks to payroll liabilities, and then you're going to want to code the transaction and journal entry to there with the payroll taxes that you paid plus theirs, and kind of zero out that payroll tax liability because it's basically being debited from their checks and going right to the payroll provider so that they can pay those withholdings for them, okay? So basically, when you're only recording the net payments, you're not capturing the full picture of payroll. And so usually your tax person, whoever does your taxes at the end of the year, they'll request W-3s and W-2s and probably your 941s so that they can actually put the correct amounts on there. So your books, if it's not matching what's on those W-3s and W-2s and 941s, they'll actually use those numbers in your tax return, not what's in your reporting purposes on your tax software, because the IRS does check. They'll go, hey, they reported way less on their tax return than they did on their 941s. What's going on here? And it could trigger an audit. So you just kind of want to make sure that you're capturing what's happening inside with those 941s. Okay, so this is the main thing. This is my pet peeve. Sorry. Okay, so a lot of people, small business owners, don't realize that there are certain tax rules, tax laws with their businesses, okay? So, and one of the most common mistakes is owner's payroll, okay? And how you pay yourselves. So I'm going to kind of go through this list here, and basically, unless your business is a corporation, unless they've got Inc. at the end, or unless they've chosen to be taxed as an S corporation, then you guys can't be on payroll. So if you're an LLC or a sole proprietor, if you're a multi-member LLC, basically you all have to take draws and make estimated tax payments, okay? So here's the list. So if you're a sole proprietor, which basically means that you're just out doing business for yourself underneath your pretty much your social security number, or you could apply for a tax ID number and have your business under that. So doing business as, you are going to take draws from your business and make personal estimated tax payments. Basically what happens is your business income or your business loss, whatever happened that year, is being reported on your personal tax return on a Schedule C. Okay? If you're a single member LLC and you have not elected to be treated as an S corp, you also are going to take draws and make personal estimated tax payments, and your business gets reported on your 1040 Schedule C as well. Okay? If you're a multi-member LLC, which means that there's more than one, so if there's 2 or more people in your LLC, you are considered a partnership. At that point, you have to file a business tax return 1065, and even though you're considered a business and have a business tax return, you cannot be on payroll. And this is the most common. Like, they think they're a multi-member LLC, I've got a partnership, I'm going to be on payroll. No. You have to take draws or guarantee payments, make estimated tax payments. You will have a 1065 business return with a K1, which then flows to your personal return. Okay. Now, S corps is in an election. So in Virginia, you can be an LLC, a multi-member LLC, a partnership, all of those things, a corporation. The S corp status actually isn't really recognized in Virginia. It's a federal thing. But if you are being taxed and take this election, you absolutely have to be on payroll. You can still take draws and distributions, but you must have a W-2 at the end of the year. Now, the IRS cannot tell you what reasonable compensation might be. So you kind of have to look at whether or not, you kind of look at your area, what somebody with your type of business is doing, what they might be getting paid, kind of, look at your income. They can't tell you, hey, I've got a loss this year, so I couldn't be on payroll. That's fine. If you only made $2,000 on your W-2 that year, that's fine, as long as you can prove that you had, a loss or, only $3,000 worth of income. So the IRS can't really tell you what reasonable compensation might be, especially if you're struggling cash flow wise, but you do have to get a W-2. So whatever that might look like, if you get a paycheck and put it right back in the business, that's fine. You just have to be on W-2. You have to get a W-2 at the end of the year. Especially now with the new qualified business income deduction, the IRS is really looking at the fact of, because the qualified business income deduction, and I'm kind of flipping this way to taxes versus bookkeeping, but they're really driving down the point that your distributions can't be higher than your payroll. So you can't have an income amount of $50,000 and only have a W-2 of $2,000, because that $50,000 as an S corp passes through to your personal return. You're paying taxes on that at your income tax level, but not paying Social Security and Medicare on that. Okay, so that's the difference. They want their Social Security and Medicare, they want you to still contribute to that. And so they're going to be looking, especially now with the new tax law and this deduction, about, okay, are you trying to slide by and not contribute to Social Security and Medicare versus, what's on your W-2, okay? So S corps will file a business return 1120S. You'll get a K1 that goes on your personal return, and then you'll also get a W-2 that goes on your personal return. Okay, corporations. And side note, anybody can choose to be taxed as an S corp, including corporations. So just a side note. So corporations, owners must be on payroll. You'll file a business return 1120. And you'll get a W-2. There's no K-1s because corporations actually pay their own tax. So they're taxed separately, and then they pay their own tax, okay? All right, so the last one, And if your tax person has ever looked at your reports and handed them back to you, it's most likely because of this right here. If you have negative balances on your income or financial reports, that's a huge no-no. So basically, there should be no negatives on the profit and loss statement at all. There's only a few instances that it could produce a negative amount, but it would be rare. So refunds that come in, so if you do have a negative on your profit and loss or your income statement, it could be one of these things. Your refunds were higher that year than what you actually spent, especially if you took an expense at the end of, we're in 2019. So if you took an expense in 2018 of $500 and you returned it in January of 2019 and got that $500 back, and then you didn't spend anything, then you'll have a negative, okay? And that's okay. But if you do have a negative, you kind of want to drive into those transactions and just kind of see what's happening and if that's the case. The other time that you might have a negative would be if you're not a service-based business and you're collecting and paying sales tax, but you're keeping that piece outside. You're not actually calculating the sales tax liability because you're not really producing invoices, and it's not, moving the funds to the liability account. So if you're just recording deposits, you more than likely might have a sales tax account, which would be considered income because it's not really income to you. You collected it for Virginia. So if you're keeping that separate in a separate box or a separate account because you want to kind of see how much sales tax you're paying out, then you need to move that from being an expense down here to being an income, and you will see a negative at that point. A lot of times, some business owners will just code it to the regular income account and it drives your income down. But you do want to make sure that you are recording sales tax payments because it's not income to you. But it does need to be recorded as income in a bookkeeping sense, I guess, because you want to make sure that it's not an expense, so it can't be down here on the bottom. So a lot of times you'll have a sales tax expense, but it's not income and it's not expense. It's still zeros, not really zeros itself out, but the math still works, but you want it to be an income account, not an expense account.
I have a quick question.
Yeah.
All right, so getting back on to refunds. I got an example for you. It's kind of weird.
Okay.
All right, so doing deck work, right? Lots of deck work.
Yes.
And making a big purchase at the beginning of the year for lumber.
Yep.
Right? Lumber is one of those few things where the price rises over time. Okay. So having my crew at the end of the year gather all of this spare lumber and taking it back to the lumber yard. And we end up getting more money back for it because I didn't send them with a receipt. I don't even think I found the receipt, to be honest with you. Please don't. Let's just move on.
Yes.
So
we will move on.
But taking it back and making more money was unintentional, but it happened. So now we have a refund where it's going to be higher than the original amount paid.
Okay, you're going to hate me, but in this instance, you're going to want to do a journal entry because the amount that you made over above the refund is actually income to you. So you would.
Another business.
So that little piece of it would be considered income. So you would want to do a split transaction when that deposit came through that you made the refund for, and zero out your cost of goods sold account for however much you spent on lumber originally, and then put the other piece up as income. But yeah, that's sorry.
Not trying to give anybody any ideas.
No, it's actually great. I mean, you're able to make some, money off of your.
Yes, we're gonna make a big purchase again.
Yes. Yeah, you might want to be just a little bit careful on that. But as long as you're recording it as income, the IRS doesn't care. So, you're just being honest. So, all right. So The other piece is at the very bottom, once all of your income and cost of goods sold and your expenses, you may have a negative in your net income, and if you have a loss that year or that month. And that is acceptable because that's the only way to show a loss would be a negative. So there might be some negatives on the balance sheet. Usually amounts coded to your equity accounts that are taken out as draws would definitely be a negative unless you're posting to the same account where the capital contribution was recorded. But in most cases, you kind of want to keep those two accounts separate. So any draws that come out for the owner would be considered, would be a negative. Your retained earnings account may be negative if you continue to have losses. Again, any other case. The accumulated depreciation is definitely going to be recorded on the fixed asset side as a loss. So there are some items on the balance sheet that would be okay. If you have a negative in your checking account, though, that means you're overdrawn. Please do not have a negative in your checking account. So now that might not be true at the bank side, but it definitely means that you've got some uncleared transactions that are happening that might need to be cleared out if you've got negatives in your bank accounts. So basically a good rule of thumb when it comes to your financial reports is if there's a negative, there's probably an error somewhere, and you kind of want to drill down and try and figure out what's happening with that. So that's pretty much what I had. So if you guys want to ask some questions, I think you said you had one.
Yeah, but it's kind of confusing.
That's okay.
I've been using Quicken, which is probably not nearly as good as this one.
Well, just a side note, Intuit does own Quicken, but it's not really, it's usually personal, maybe Schedule C stuff.
Yeah. And we do it on a Schedule C. He's an LLC, but he's sole, and I have my own little business, and I'm just a sole proprietor. But he made more money last year than what we've made this year. Mm-hmm. But then we also took a withdrawal to pay off our house a little bit out of the 401k. So we have more taxes this year, but we did it this year because we knew we made less money this year. But now we're having to pay estimated taxes, but there are this quarter we didn't make what we made the first quarter, so we needed to put personal money.
You do not have to pay estimated taxes if you aren't going to have the same amount of tax owed.
But we will because we took some money out.
Because we had that personal draw,
Yeah.
that's taxable income,
Yes.
but outside
And
of the
did you take it early?
No.
So
I
you
just have
were.
to pay taxes, I don't pay penalty on it.
Right.
Nice.
I'm old enough that I can.
Thank
do
you.
Right.
Usually,
Yeah,
if you take it early, then it's like 35%.
No,
You
we
lose like
wouldn't.
35% of
No,
your retirement.
we wouldn't.
Yeah.
Okay, good.
Yeah. And we just added it to some savings. To do
So
that.
you don't necessarily have to make them. So you could double up, but this
You're
is.
gonna pay it now or later either
Yeah,
way,
we're
so.
going to pay it now,
Right.
we'll pay it later, but we were worried we'd have to pay a penalty if we didn't. And our tax person told us that you have two options. You can pay 90% of what you think you'll owe, or 100% of what you paid last year.
Right.
And so we know last year's will be less, so we're paying that. But my question is, if we're putting money, because we're running it through the business, because that's where we're doing the estimated taxes, what do you code that as? I was hearing you say the equity.
Yep, it's a member draw.
Okay.
So it definitely can come from, that, like I said, the IRS doesn't care where it comes from.
And it's not income, because I don't want to pay tax on money.
Well, okay.
Because
We already paid tax
we're
on
taking
that.
money that we're paying taxes on from our personal side and putting it into the business. We don't want to pay taxes on it.
So you're not paying, okay, so this is the thing. Did you contribute funds? Do you have equity inside of your business, either from profits that you've made previously, etc.? Then it's not necessarily taxable, but you will pay tax on the profit that you made this year.
Sure.
So
Right.
when it's being coded, it's not an expense because it is a member draw. So it won't reduce your net income here. You will pay tax on this side, on your balance or on your income statement, but you're taking it out of equity. So, if you've already paid tax on it previous year from previous years, you have enough profit in there, you're going to be kind of okay. You're not technically being taxed on this portion of it on your balance sheet, but you are going to be taxed on the net income because it's not decreasing, because it's posting to the balance sheet, not the income statement. Does that make sense?
I'm not keeping enough money inside of the business though, that I'm taking some personal, I keep it outside. So let's say I wanted to buy a new computer. I might have to take money out of my personal funds and put it back into the business as a capital
Contribution.
thing, you know? So I just want to make sure I'm not being taxed on that money again, because I've already taken the draw from the business to do that. Does that make sense?
Technically, you are not being taxed on it because it's hitting the balance sheet. So any money going in and any money flowing out to you personally is going to hit the balance sheet. But so you're not technically being taxed on the balance sheet, you're being taxed on the profit that you made this year. And it doesn't reduce your profit because it's a draw. So member draw is nowhere on the income statement. And so if you took $1,000 out, it doesn't reduce your profit down here. You're technically being taxed on it on this side for an income this year, but it's not, you're not technically being taxed on it on this side. So that's where the confusion comes in. A lot of people go, well, I paid taxes on it last year. I should be at zero. I should have a loss. Well, it's not going to hit your income statement. So you're being taxed on the profits from this year, not on the balance sheet side.
I think I'm with Josh, and I think this is a call Shelley thing. Yeah.
So
That
your
what you
tax
said
planner
there.
should be able
Yes.
to, she should be able to flip her software to the planning side. You can give her and tell her this is how much profit we're making. And she can put the numbers in and say if your estimated tax payments are accurate or if they need to be raised or if they could be lowered. So she should be able to do it. She probably will charge you for an hour of her time. I don't know, but she
Might
can
save money in the long run. Though.
Yes, she can flip it and kind of walk through what, it's not an exact science because, the whole year's not done yet and these are approximate numbers, but she should be able to flip her software, give her some approximated numbers, say I'm going to make this much this year, this is how much I've taken out. Don't include what you're going to take out in this profit number, okay? And then she should be able to kind of let you know.
Thanks.
Anybody else?
I have a question. I'm not the only one using the software, QuickBooks,
Okay.
and a deposit was entered, and they manually checked it off as reconciled. And so then when I went to do the monthly reconciliation, it's throwing it off.
Okay.
And I don't know how to fix that.
Go to the register itself, and are you in QuickBooks Desktop or online?
Desktop.
QuickBooks Desktop, I think online the same way. If you actually click on the R inside of so go to the transaction itself inside of the register and click until it's cleared. You don't see anything there. So you don't want it to say C and you don't want it to say R, and then hit save. It'll give you these bunch of warnings saying you really don't want to do this, but just go ahead and hit yes. And then you should be able to see it when you go to reconcile next time. Basically, it was reconciled previously or manually inside of the register, and so once the R is on that transaction, it won't go into the reconciliation piece of QuickBooks. So you just take that off and your beginning balance should flow, or it should revert back to what it was, and then you'll see that transaction and you can click.
So trying to fix it, I deleted it and re-entered it.
Yeah.
But it still threw off the reconciliation, even though I deleted the transaction.
Okay, so you see it in the reconciliation screen now?
No.
It's still not there, so just check and see if it still has an R there.
Okay.
Get rid of the R and then see if it will go back to normal or go back, your beginning balance flips back to what it was. If not, the only other thing I can think of is to undo last month's, redo May, and then redo April and then May. Yeah, but there's probably an R in that transaction. You just unclick that and you should more than likely be able to see it. If you can't, then yeah, call me and I can remote in and we'll walk you through it. Yeah. Yeah. So, you're welcome. Anybody else? Oh, come on.
Well, I have like a more personal that, I would like to have like a bookkeeping business. So I only have like on the job experience.
Okay.
So what do you suggest for me to start?
I only had on the job experience too. I pretty much self-taught myself QuickBooks Desktop and learned QuickBooks Desktop before there was a homepage. So when I'm coaching clients, I always have to remind myself to go there first because I'm so used to going to the menu up at the top. So, so I'm not technically a certified bookkeeper, but they do have those institutes out there. You could definitely take classes and become a certified bookkeeper. I basically didn't really start to market myself until I got my enrolled agent status 3 years ago. So I was pretty much just on the job training, had worked for other bookkeeping firms or had my own clients and I was a subcontractor for them. But if you've got bookkeeping experience and you've done it for tons of years, then just basically you want to get a website, get some business cards, start networking, and I have a little niche, so I'm a little bit different than a lot of accountants out there because I am a QuickBooks Pro Advisor. So my thing is that I will coach small business owners how to use QuickBooks and QuickBooks Online. I'm a Pro Advisor in both. And for me, the thing is I understand costs and keeping costs down. And I understand the fact that you want to do accounting yourself. And if you're going to do that, awesome. But please do it right. So the people, there are so many people out there that just, they don't do it right. And so then they come to me and they have a mess. So then I have to fix it, which is awesome. So I'll do projects. And a lot of times my projects turn into clients that are put on retainer. So, because they see the value of what I'm able to give them. And I'll coach them through everything that they did wrong. And so I have coaching clients that as long as, I've done a coaching package with them and we kind of gone through all of their mistakes and they'll call me and they remote in or I'll remote into their system for 15 minutes and they pay me for those 15 minutes. So you just kind of, you kind of want to, and not a lot of accounting firms will do that. They're just there for tax season. They're just there for bookkeeping. There are some clients or some accounting firms that if you don't have this much in gross sales, they won't talk to you. That's not me. Because I'm a small business owner. I would want help if I only had $2,000 worth of income, but I had, even if it came from my personal funds, I will pay you an hour to show me what I'm doing wrong. So, you just kind of want to, so I'm fine with small to medium businesses, and a lot of people will, I have, like I said, the networking firms. If you get out there and you tell them that you're willing to take those types of people or coach them, then, you'll get names, you'll get referrals, and that's the best thing is word of mouth. I hardly advertise. I really don't, and it's not because I don't really go to networking events because I am so shy. I hate it. I can't stand it. So I'm really good with one-on-one and with my clients. If you come in, I will be there. I'm right there with you. We'll do everything together. But this type of thing just makes my stomach hurt. So you see what I'm saying is so that's just how I kind of went about it.
You mentioned earlier that you were an enrolled agent.
Yes.
A few years ago, I guess you got that. Can you explain what that means?
So an enrolled agent means that I can represent taxpayers before the IRS. I actually am qualified to prepare tax returns, whether it's personal or business returns. And if you have an issue, like you get letters or whatever and kind of walk you through what the IRS is looking for. I could technically get power of attorney and represent before the IRS and any issue if you wanted to appeal it, but that's really not my niche. And if I prepared the return, I'm going to want somebody else to actually represent you because then you're kind of looking at, if I made an error on the return, then I get penalized for certain things. And you want your person that's representing you to be 100% for you, not necessarily for me too. So in those instances, I may send you to an enrolled agent or a tax attorney to kind of walk you through, but that's rare. That doesn't really happen a lot, but basically I can get power of attorney, call the IRS for you if you have an issue, and kind of figure all that out. But yeah, it's mainly just preparing tax returns, and I know tax law, I have to get so many hours of continuing education each year in order to keep my credentials. So that's probably one route that you might want to go, even if you don't want to prepare returns. It will tell you what tax law is, and you would have a better foundation in order to code for bookkeeping. So
Where's your office at?
I'm actually off of Garrisonville in Stafford, right off of 610. I don't know if you're familiar, but there's the Wawa off of Eustis. I'm right before there. So there's a post office. Barrett Heights is that turn right before, and I rent from a construction company back there. So, and my mentor is there as well. She's awesome. She's been in the business for 30 years, and yeah, she just anything that I need, she's just right there. And eventually, I have she wants to retire in the next few years, and I have the opportunity to buy her out. So it's just really great blessing.
That would be an intangible asset, right?
Correct. Yes. Yes.
Did you have any cards with you that?
I do. I did bring some.
I'm the treasurer for Historic Fredericksburg Foundation in downtown, nonprofit.
You guys can just pass them around if you want them.
I need some help in QuickBooks. I mean,
Me too. I need one.
So I don't do Quicken.
no, it's QuickBooks.
QuickBooks.
Yes.
No, it's QuickBooks. I'm sorry.
You can take some too and pass them out if you want to your friends. That's fine. I have tons. So
So you mentioned Quicken and QuickBooks, and we're using
Quicken.
yeah, which is more of a personal software, I would imagine.
yes,
So we're probably not doing all those things you just talked about. So
it's very Quicken doesn't have the balance sheet and piece of it. And yeah.
So if you're going to transition from Quicken to QuickBooks or to it, you said Intuit was the sister company.
Well, Intuit actually owns QuickBooks and Quicken.
Oh, okay.
So yeah.
What would you say is the cost of doing such, and is the transition easy? Can you download one from the other pretty easily, and all of those kind of things?
Okay, so what type of business? I guess I'm gonna kind
It's
of.
a consulting business, and,
Okay.
and I don't.
Are you a
serve
government
also-
contractor?
No,
Do you do job costing?
I don't know what that is, so I'll be saying that.
Okay. QuickBooks Online does have the job costing piece, so that wouldn't necessarily be something that you wouldn't go with, but so you could more than likely go to QuickBooks Online. Their Simple Start, I think, runs between $10 and $20 right now a month. There are 4 subscription levels. Simple Start probably will work for you, but if you're gonna actually bill, like put your bills in for accounts payable or pay 1099 contractors, you might need to up your level, but start with Simple Start for now. Quicken, if I'm not mistaken, it will accept the transfer in. I know QuickBooks Desktop goes to QuickBooks Online, but here's the key. If you, in the future, think that you may ever want to flip to desktop, QuickBooks Online does not go to QuickBooks Desktop. You would actually have to enter history, and we would have to do a project to kind of make sure that.
And do you do that kind of consulting work where you help people do that? That was really what I was getting at.
Yes, I do help. Yep. So, and even if Quicken doesn't move, we can put the history in QuickBooks Online. And yeah. Anybody else? So, yeah, feel free to reach out on my website, whatever you guys need.